Hello guys, welcome back to another video. In this video, we're going to talk about high probability trading versus low probability trading. So, the code behind trade ideas. There are only two kinds of trades we can take: a low probability trade and a high probability trade. High probability trade is a trade that is in alignment with the long-term perspective and intermediate-term perspective. Low probability trade is a trade that's against the long-term perspective and when the intermediate-term perspective retraces. So, high probability trades is when you have a long-term high in, break in market structure confirming that long-term high, price retraces, creates that failure swing, forms an intermediate term high, breaks market structure again. And if you're taking trades that are aligned with these two perspectives, that's a high probability trade, especially when the draw on liquidity is clear. This could be a fair value gap, internal range liquidity exit, or an external range liquidity exit when it comes to clean lows, right? So if we take trades that are aligned with the long term, intermediate term, and the draw on liquidity is clear, that's a high probability trade. Low probability trade is when you're trading against that framework. So let's say you see a buy signal here, and you expect the intermediate term perspective to retrace up higher, maybe to a fair value gap here, back into a premium. You can take that trade, but just realize it's low probability since it's against the narrative and context and intermediate term swing points in the market. Okay, if price does form an intermediate term swing low due to the context narrative from the higher time frames, this is expected to break. All right, so if you're taking a trade based on it, yes, it can go up and fill a fair value gap here. Yes, you can make a certain amount of pips, but just know that it's a low probability trade. So you have to distinguish between the both, because we treat these trades differently, hence the code behind trade ideas. So let's talk about high probability trades. Since these trades are in alignment with the long-term perspective and intermediate-term perspective, it is in your best interest to let the entire trade run instead of closing half of it or closing it all out entirely. So in terms of target, high probability trades have a further target. So let's give you an example with a one shot, one kill example. So we're going to start on the long-term perspective here at the euro dollar. Price is retracing within this range here. This low to this high. Okay, before we target these lows here, we still have an internal range draw on liquidity in terms of this fair value gap. So price should come rebalance that. Study what's happening here. Price is showing signs of bearish institutional sponsorship with resistance levels holding and support levels here breaking. So we want to stick with that. And how can we get aligned with that? Well, we have a fair value gap here. We should anticipate that to be a long-term high now, okay, because it's a higher time frame level. And where's the draw on liquidity that we can aim towards? This low first, and then this fair value gap. So since that hit the higher time frame level, sure, you might have got stopped on this one. It happens, but this happens again. Okay, retest that level and breaks this low with displacement. Price rebalances fair value gap, and now since we have a long-term high here, a rebalanced high becomes intermediate term high in terms of structure of this point here and this point here. So if we have an intermediate term high in, what do we expect? We expect bearish institutional order flow to take place now. So up candles, such as this one, will act as resistance, and we should be aiming for downside objectives, right? Because the drawn liquidity is here. But before we go to the drawn liquidity, do you see any price targets from this high to this low? If this is the range we're trading in, what's the price targets? Well, we have a fair value gap here. We have a fair value gap here. These are internal range liquidity exits we can have for a short-term target. And we also have this low. So we could be aiming for these points, but ultimately in that draw liquidity. So that's the order block. This is the internal range liquidity exit and external range liquidity exit. We're going to be aiming for those points. Okay. And since it's aligned with the weekly chart and the daily chart, we're blending both of those perspectives together. Now we have a clear view that, okay, price wants to trade lower. Would it make sense to close early at this point? No. It would make sense to hold for a big move, since we can expect big moves to happen at higher time frame levels. And just take a look at the market structure here at these higher time frame levels. So there we have it. We have a big displacement. But let's study how we could have entered this on a lower time frame. So this is the intermediate term high, which is the rebalanced fair value gap. Okay. Price pierces into the order block at the intermediate term high, then broke market structure, which is a confirmation sign that it wants to reverse now. So do you see the parent price range? Here, here. Okay. We're going to treat this as a long-term high in terms of this daily level. Okay. But this is an intermediate term high based on the weekly level. So this is the parent price range. Since we're expecting downwards price action to our targets here, if price trades back to the premium, that's a short. We expect this high to hold, since it's with the narrative and context. We expect this low to break. And this pump right up here, sure, it looks enticing that, oh, it might go up higher. But that's the point of a failure swing, guys. Failure swings are meant to trap people to ultimately fail. So you could use premium discounts, or you could use optimal trade entry. It's pretty much the same thing. And what we're doing for swing projections is we're using the parent price range. We're looking for a 0.5 extension, which brings us to the high of that fair value gap. 1 to 1 extension, which brings us to the low of that fair value gap. 1 to 5, which brings us to that external range liquidity exit. Price retraces back into a premium. So this is where the failure swing is anticipated to stop, right? Failure swings stop in the premium because it's already met its market maker objective, right? Market maker objectives for a failure swing is to trade into a premium, induce longs of the market, build sell side liquidity down here, whilst also meeting objectives, taking out shorts here. Okay. So in that optimal trade entry, we have our targets. Now let's study the structure. So since it's at daily level, acts as long-term high, long-term low, that's the price range. We're in optimal trade entry. This failure swing, study what it did. It took out this high. And since we're going to anticipate this high to hold now, this high should be lower than this one. And if this confirms, that is an intermediate term swing point, a classical run, right? A classical intermediate term swing point looks like this. All right. So once we expect price to trade back in optimal trade entry, Maybe there's no short entry here. But look at this. The moment we hit optimal trade entry again, we have a displacement with a fair value gap. Pair that with an order block, right? And since this is a short-term high and a higher high, price should not see itself come back above this point again, especially under the context of this long-term high. Okay, we should then expect all opposing levels, such as this order block or this fair value gap, to break, this fair value gap to break, and then ultimately this long-term low to break. And then once the long-term range breaks, price can make its way to those swing projection targets. So you can put an entry at that order block and fair value gap, stop above the intermediate term high, since we're framing our trade based on the intermediate term high. Stop above that point, entry at the order block fair value gap, holding towards swing projection targets. And that's one shot, one kill. Since it's aligned with the long-term perspective and intermediate term perspective, if we see an entry pattern and it's following these principles here, and the weekly chart as well, of course it's going to have a big move to the downside. Okay, and really you don't have to hold for as long as 10R. 5R is great. Or you could have just closed below this low, and that would have been perfect, right? If you really want to hold for these longer term objectives, you can leave 30% of your position running. Okay, you don't have to hold the full risk to these points, because imagine how you would feel as a trader. You'd probably be struggling to sleep and everything. So it really depends on if you can handle it or not. If you can't, that's completely fine. So low probability trades. Since these trades are against the long-term perspective, it is in your best interest to pay yourself partials around logical areas. So logical areas are opposing levels or an opposing liquidity pool. Pay yourself when there's an opposing level. Okay. Since at any time or any moment, the intermediate term perspective can snap back into alignment with the long-term perspective, it makes sense to close partials and pay the trader. So what I mean by this is, if we have a resistance level here, price is traded into that resistance level, and we have a parent price range already. Okay, this is the parent price range. This is long-term high. This is long-term low. A low probability trade is once you're trading a retracement, okay, against the long-term perspective. Okay, you're trading that retracement. But since at any time the intermediate term perspective can snap back into alignment with the long-term perspective, okay, you want to take quick profits, right? Don't hold for wanting to get absolutely extreme prices to exit. No, if you see a liquidity pool here, take it. It could be a 2-to-1 trade. It could be a 1-to-1 trade. Just pay yourself, since it's considered a low probability trade, and at any time, since it's opposing the long-term high, this could snap back and trade aligned with the long-term perspective. And you want to be trading aligned with the long-term perspective, because that's a high probability trade, and you can hold for longer displacements in the market. So we're just using the same chart here. You can see how these are relief rallies, right? And that's counter trend setups. So maybe on the 5-minute here, on the 15-minute here, you could take a long, because this is a daily level. This is an opposing level that can cause a retracement, right? This is a daily level. It can cause a retracement. So you could take a long here and exit at this fair value gap, right? But imagine if you said, oh, I'm going to hold for this fair value gap here. Watch how price just snaps back into alignment with this whole framework here. Okay, so these are low probability trades. Same thing here. Price at a daily level in terms of the external range liquidity exit. Maybe there was a buy here, right? You can see how it taps this order block real quick and rebalances here. That is a trade, but since you're going against everything here, it's a low probability trade. because at any moment, price can just snap back and trade back into alignment with the long-term perspective. So for the most guaranteed way to find consistency in your trading, stick to high probability trades only. Okay? Short-term high, intermediate-term high, market structure shift, failure swing back to premium, order block with imbalance, take short there. Okay, optimal trade entry, just a simple pattern. But you want to be trading aligned with the long-term perspective, because not only will you have bigger moves, right? It's more high probability. Trade aligned with the higher time frames if you want to find the most guaranteed way for consistency. You don't have to be scalping up, down, up, down, up, down, up, down, up, down. There's no point. If you want to find consistency, you want to make this work for you, there's no need to be trading like that. All you need is one good trade a week. Imagine if you're able to make 4% a week, right? You just risk 1% on this trade here, and you just found one good setup. But you can do that every week. Is that not consistency? Is 4% a week not good enough for you? Or maybe it's 8% a month. Since you should be aiming for 8% or 10% a month, just trade with high probability trades. Because if you did choose to take low probability trades, that could lead to a downward spiral. One loss could lead to another loss, and another loss, and another loss, just because you get more emotional. But if you take a loss based on the higher time frames, that's information, right? It's telling you something. It's a cost of business. But if you're taking a loss on a low probability trade, is that really a cost of business for you? Is it telling you that the market's going to reverse? No, it's just telling you that you're probably forcing trades. So to not force trades, be more patient and focus only on high probability trades. And these are trades that are aligned with the higher time frames. So let's talk about some poor performing trading habits that you might have. 1. A poor trading habit is framing your trades without any context of the long-term perspective. So like mentioned previously, to find success with interbank methods and concepts, everything needs to be following the long-term perspective. A fair value gap or an order block doesn't hold because of the name. There's nothing special about a fair value gap or an order block if you're not following the right context of the market. Everything needs to be framed under the right context and narrative, and only then will these interbank patterns unlock for ultimate precision. So like, let's say you wake up and then you just jump right into the 1 hour chart. You didn't check what the daily's doing, the weekly's doing, none of that. And you're looking at these interbank methods such as order block and the fair value gap. Okay, this one holds. So you're expecting, okay, another one because we just broke market structure. The previous order block and fair value gap holded. That's another market structure break. I'm going to take the next order block and fair value gap. But there's no context. You can't just trade based off a market structure break. That's not good enough. Since this is an order block and fair value gap, that's a high probability pattern. But without any context, it's almost guaranteed to fail. So let's give you some context here. This is the context. Price is trading from this high to this low, and price is an extreme discount. So if we're going to make our way back into premium, you'll see buys happening towards that. Look for buys in this area. We're going to frame our trade off the long-term perspective. So we have a discounted market. Okay, ticking out low. It looks like it's going to retrace back for drawn liquidity in terms of the rebalance here. So how is it going to get there? Is it just going to go up, 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 up? No, it's going to walk there with down candles and up candles, down candles and up candles. So if we see a down candle in a discounted market, we're expecting that to be buys. Okay, so this order block prints for an aggressive entry, tap. This is the moment we go into a intermediate term perspective our short-term perspective, and we start looking for buys all the way into premium fair value gap. Or it doesn't even have to be that premium fair value gap. If you look before that, we have a internal range liquidity pool here. So you could have looked for a buy here and out here. So now we have context. You can see why these trades fail now, right? You can see how these A plus trading setups are expected to fail, because if you're looking at this and saying, okay, that's a market structure break, with context, you're shorting support at this point. You're shorting support this time. Okay? With your trust in institutional sponsorship, even if the opposing setup is A plus, we're expected to fail. Okay, so even if you say, oh, up candles, resistance, up candles, resistance, it's not good enough. You start with context from the long-term perspective, then you identify institutional sponsorship, then you can trust institutional sponsorship. So with context, you can see how easy it is to identify institutional sponsorship and then select your favorite interbank pattern to get in sync with institutional sponsorship. So this order block here is acting as the parent order flow. We have a market structure break. We have a breaker. We have a low, high, lower low into the level. Liquidity pools can cause reversals. We close above it, retest, and there's a small fair value gap in there. So breaker and the fair value gap is an A plus setup. But you don't even have to know if there's a breaker there. You can just say, oh, that's a market structure break. That's a higher time frame level. Okay. My entry pattern is a fair value gap. That's it. You don't have to know these breakers. It really depends on what you see best. So we have a displacement to the upside. Due to the parent order flow, we should see price trade higher aggressively. Maybe you didn't catch anything up here. You wait for an intermediate term swing point to frame your trade on. So we see here, rebalance, creates an intermediate term low, displacement, can take action, find support levels based on that intermediate term low. What do we have? Well, we have all these down candles, consecutive down candles. So 1, 2, 3. We're going to add that together, and that's going to be a 3-hour order block. 50% of that is a buying opportunity, but you don't even have to know about order blocks, right? Maybe you are better at trading optimal trade entries than this low to this high, framed off an intermediate term low. 62%. Targeting that drawn liquidity and swing projections for the optimal trade entry. Okay. Same thing here. Rebalance low. We can look for support levels based on that, and that could be a little scalp. Okay. But the moment we hit that drawn liquidity, stop. Okay. That's where you want to end your trades. You're not expecting it to break. You're waiting for more information in the market. So another poor trading habit a lot of traders have is rushing entries at the weekly open. Okay, so maybe it's Monday and straight away in Asia, they're looking for trade setups. Rushing. They've been waiting all weekend. Well, I can't wait till the market opens. I want to get an entry. I want to make some money. Well, let me tell you some truth, guys. Trading is not like any other business. More trading hours does not amount to better trading results. You can't force a trading setup when the price is not bound to move. So any other business is, they like to follow the hustle mindset. So, this I'll sleep when I die mindset, or I'll put put more hours so I can get better results and beat my competition. Trading is not the same. For trading, you have to wait for price to move. And if the banks and financial institutions are not ready to move price on a Monday, then it's just going to trade in a small range. Okay? Monday might trade in a small range. And if price is not moving, then how are you going to find trades? How are you going to find a one short, one kill setup? You can't. Banks and financial institutions understand that retail traders are in a hurry to find trades on market opens. Knowing this, prices will stay stuck in a range and trap as many retail traders inside the range. So you can see this with the daily range, you can see it with the weekly range, you can see it with the monthly range. I'll give you an example for the daily range. Asia will normally trade in a consolidation. And then London will form that Judah swing, take everyone out on Asia, and then trade lower. You see, Asia is the first session of the daily open, and people are in a rush to find an entry at daily open. But if it's not ready to move, then it's just going to trade in a range. And then you'll see this pattern so many times. We can do the same thing at the weekly open. Where weekly opened, Monday doesn't do anything. And then Tuesday or Wednesday takes out all the traders on Monday or Tuesday and then completely reverses. Okay? Because the retail traders that were hurry to find trades on the market opened, they're stuck. And their liquidity is going to be used to pair orders to bring the market down lower. So knowing this, knowing that traders are in a hurry to find trades in market opens, banks and financial institutions will trap as many traders in here so there's liquidity building above the market and below the market. Sell stops, buy stops. Okay? They're accumulating all this liquidity. So when they're ready to take action, they can use it. Because banks and financial institutions, they're such large players, they need to build liquidity for their orders. They can't just click buy and sell like me and you. They have to build it. And how they build it is by keeping price in a consolidation. Think like a market maker. So here we're on the long-term perspective. This is a daily chart. Here we have a fair value gap. Test it once, test it twice, taking out an internal range liquidity pool inside the fair value gap. Okay, so that's a high time frame level. You can see it hits a resistance level here. We're going to study on the lower time frames how price reacted. But since we're expecting price to go lower, sell some liquidity, targeting institutional figures, let's study what happened here on the lower time frames. So even though it follows your typical long-term high, long-term low because of this daily level here, okay, that's your parent price range. This is the weekly open, and imagine the rush to find trades here, 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 okay? It's trapping traders and it's building liquidity in the market. Now I'm going to tell you how do you know when price is going to break out that range for trading the weekly range. How do you know when it's not going to be in a consolidation? How do you know when to trade Monday? How do you know when to trade Tuesday or Wednesday? How do you know when not to trade Monday, Tuesday, or Wednesday? It all depends on the economic calendar. So study the economic calendar every Monday because that's going to give you the clues for the weekly range. Okay, so the clues were staring at you the whole time. There's no news on Monday, so there's no smoke screen, there's no excuse for the markets to move. So this is when the market's going to stay quiet because there's no excuse, such as high impact news, for price to move. There's no volatility. We have news on Tuesday, right? But you gotta look Monday through Friday, what is the main news event? You can see the main news event of this. So if the main news events are late in the week, price is going to hold for those news events. And then once the news events happened, volatility happens in the market. Okay? And all these retail traders that are rushing trades on a Monday, Tuesday, anything before the main news event of the week, they're going to get fucked. Excuse my French. So this was the main news event. Okay? And notice how after this point, price starts moving. Okay? Following what we had here. So don't be in a rush. Okay? You can see the moment the news events happened, clean trading happens. You have a high. New York kill zone forms a high. Displacement to the downside because we're in the resistance. We're expecting lower prices. Bearish institutional order flow. We're shorting resistance levels. We're expecting support levels to break. Okay? Asia happens. Displacement. Fair value gap. Displacement. Fair value gap. Displacement. And all these moves are happening in kill zones, which we'll talk about in a bit. Okay? But just study how price finally starts to move after the main news driver happens. But before the main news driver happens, everyone's getting trapped. Everyone's getting trapped. And you might have experienced this yourself. You might have entered a position, price didn't move, and you're at the point where you don't want to close the trade because you're invested so much emotionally in it. And then you're holding it for 1 day, 2 days, it doesn't do anything, and then out of nowhere it just jumps. Well, this is how you combat that. So warning, there are exceptions to this rule, okay? If price has reacted to a higher time frame level on the previous Thursday and Friday, trading the weekly open on Monday and Tuesday is eligible. What do I mean by this? So let's say this is the weekly open for your current trading week. Okay, this current trading week. This is the weekly open. If you look back and you see Thursday and Friday, okay, they already hit a higher time frame level, and you already see a market structure break. If Monday produces that failure swing, you can trade Monday, especially when it hits that intraday or intra-week drawn liquidity. You can trade that. But you have to see, okay, what happened the previous week? Did the previous week already trade off a higher time frame level? And if so, that means the weekly open, there's going to be excitement. Okay? Excitement on the weekly open. But if that's not the case, the previous Thursday or Friday, it didn't react to anything, there's no excitement in the market. Another situation is if price has reacted to a higher time frame level on Monday, trading the weekly open is eligible. So let's say Monday, this is the weekly open, and Monday hits a higher time frame level. London session or New York session, you typically want to be focusing on these ones. Trading the weekly open is eligible. Okay? But if we haven't hit a higher time frame, level on Monday, or we haven't hit a higher time frame level on the previous Friday or Thursday, don't rush to find a trade. Okay? Even if you say, okay, we can long into that level, just know that without the proper framework and context and narrative and understanding of if it's a high probability trade or low probability trade, just don't rush it. Market rewards patience. Okay? So we're back on this daily time frame. Order block, we have clean highs here. We can also mark these clean highs as targets. Fair value gap here. Here's an example of when trading the weekly open is eligible. This is the weekly open. Look back, Friday. What did Friday do? We're in a discount and we've taken out daily low and we broke market structure on a Monday. This is when we can trade Monday because Friday reacted off a higher time frame level, daily low, with confirmation. So if we trade back into this fair value gap here, it's a buy. Okay, it's eligible. We can see movement early in the week, especially when there's clear narrative like this. I call this one on the YouTube channel. Here's another example. Weekly open. What happened on Friday? Well, Friday hit that higher time frame order block. Monday had that break in market structure. This is when we are allowed to trade early in the week, Monday and Tuesday. So if the previous week hit a higher time frame level and we open with excitement in the market, that is only when you're allowed to rush entries early in the market. But that's not the case if we go back to the economic calendar and we have news late in the week. Price is most likely going to want to hold for that. A poor trading habit is trading outside of kill zones. So similar to any real world business, the financial markets have their respected operating hours. It's like when you can't go to a bank at 2 in the morning, or you can't go to a bank at 1 a.m., right? The bank has their own operating hours. So trading is the exact same way. Assets that include the euro or the pound move during London hours. Assets that include the Australian dollar, New Zealand dollar, and yen will be mostly trading during Asian hours. Okay, because that's when their currencies move. According to their time zone, that's when they're active, okay? So aspiring traders fall victim to thinking the markets move 24 hours a day, 5 days a week. Relating back to that hustle mindset, doing more, okay? No. Just because the market's always moving, okay, doesn't mean you can be always trading. There are business hours where you have to operate in, and that's actually an advantage for professional traders because we can schedule our week to these hours, which we'll talk about at the end of this video. So the truth is, the highest amount of market volume is generated within selected hours of a day, but candlesticks will print 24 hours a day regardless. Alright, so if you're looking at a 5-minute chart, there's always going to be 5-minute chart candles printing. Okay, but once we're in an important hour such as London session, these candlesticks suddenly have volume behind them, and they'll just have large expansions. Because the truth is, the highest amount of volume is generated within selected hours of a day. Okay, but once these hours are done, price is just going to go back with low volume candles. Trade during the highest amount of volume per day, okay, which is the kill zones. Since the highest amount of volume is generated during peak hours, Asian session for Asian pairs, London session, New York session for foreign currencies and dollar pairs, trade during these peak hours because important highs and lows will form within them. What are important highs and lows? Intermediate term highs, long-term highs, long-term lows, intermediate term lows. All these important highs and lows, they form within kill zones. And you can go through this yourself. If you want to see a fast response, you must execute your trade during these peak hours. Because if you're not executing within these peak hours, like I said here, you're going to be stuck in these ranges. And then your emotions are just going to build up to the point where you can't hold the trade anymore, and then that emotion just builds on top and on top. It just accumulates until you have so much emotions behind your trading, and the higher your emotions is behind your trading, the level of accuracy decreases. Okay, so all of this can be easily avoided if you just respected, or you just avoid these poor trading habits. So this is an example. Look how trading setups, important highs are forming within kill zones. Movement is happening in kill zones. And then when the daily ranges close, 15, okay, that's when if the close happens, you can see how we're printing candles, right? Printing candles regardless, but it's not moving until we're in an important time. Here, you can see that, okay, price starts moving now. Displacement within the kill zone. Displacement within the kill zone. Important highs, setups, and movements. But then, if it closes, what happens? Printing candles regardless, okay, but no movement until Asia happens. Okay, forms important low. London, it forms important low, then high. Movement happens. So trade specifically during these kill zones. Those are business operating hours. You don't want to go to the bank at 1 a.m. Otherwise, you're just going to be sitting there waiting for them to open. Okay, so you can see how important highs and lows form within these kill zones. Asia forms an important low. London kill zone forms an important high. New York kill zone takes out that important low. And what you see here, guys, we see a market maker sell model. Original consolidation, reaccumulation, smart money reversal, lower sell, displacement, distribution, 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 clears original consolidation. And we're done. So here is the market maker sell model. Okay. Asia forms an order block, rebalance low. You can frame a support on that rebalance low, accumulation, institutional whole figure. We can sweep that for liquidity, 10 pips, long kill zone, print an order block, lower sell, displacement, taking out low, displacement, optimal trade entry from this higher low. And since we're focusing on distribution now, resistance levels are going to hold. Support's going to break. Up candle, displace, resistance. Up candles, resistance. Clears the original low. Okay, so this is my favorite pattern, and we're going to talk way more about the market maker sell model in the Braveheart membership, because this is how I personally trade, and just a moment of appreciation for the amount of beauty in this pattern. So now let's talk about high performing trading habits. So the first one is framing your trades on the higher time frames. Okay, framing trades on the higher time frame levels. After following this video series, it must be clear at this point that the long-term perspective has the biggest influence on price action, because that's when the banks and financial institutions operate on. They operate on the higher time frames. So therefore, make it a habit to frame your trading ideas around the higher time frame level before you maneuver into the lower time frame. Trading based on the higher time frame level will also provide higher risk to reward setups. Why? Well, higher time frame levels is where the banks and financial institutions move price. That's where most of the volume is generated. So of course it's going to be bigger moves. With bigger moves, we can frame a high risk reward setup. And if you focus solely on trading based on higher time frame levels, since there's high risk reward setups, it's easy to find a 3-to-1 reward to risk setup. And with 3-to-1 reward to risk, you only need to be correct 30% of the time. Okay. What you need to do and make a habit of is develop the patience for price to trade at these areas. Because once a higher time frame level becomes activated, expect large range candles for multiple days due to the amount of volume being generated from it. So if this is a higher time frame level and you know it's going to trade towards that point, you're not looking for any trades here. Okay, you're waiting for this a confirmation, then you can start participating in it. And guess what? The volume generated from this point is going to be shown with multiple days of selling. So you'll have a lot of opportunities to trade. Because once we hit that higher time level, if it's a key one, that sets a trend. And that's when you'll see long-term moves happen for 10, 20 days where you're just being a seller. But you gotta wait for it to hit that level first. You might have to wait 2 days. You might have to wait 3 days. But once you hit it and you have 20 days of just doing it, selling, then you're rewarded for your patience. So then it's your duty as a trader to navigate that order flow from the intermediate term and short-term perspectives once that higher time frame level becomes activated. 2. Choosing key levels that align with institutional order flow. After the higher time frame becomes active, that will become the parent order flow for all subordinate moves to come. You must select levels that align with that order flow. Once again, higher time frame level. That will become the source for subordinate moves to come. Select levels that align with that source. Frame your trades on intermediate term highs that align with that source. But first, wait for the confirmation that the level is active with the market structure break. So after we hit that level, do we have a significant market structure break? Second, wait for an intermediate term swing point that aligns with the parent order flow. Okay, so you're waiting for the intermediate swing point here and here that aligns with that high time frame level and the market structure break. Third, frame your trade idea on that intermediate term swing point. So let's say intermediate term high comes in. Frame your trade on that intermediate term high now. It could be a fair value gap. Then you could use an order block and then another fair value gap. But you're framing your trades on that intermediate term high because that intermediate term high is framed on that long term high. And you're doing all of this here on the short-term perspective, which is your entry time frame. Okay? So now let's talk about high performing habits from the short-term perspective. So this is what you do on the short-term perspective, all right? Trade based on confirmation, not anticipation. With the context and framework from the long-term perspective and intermediate-term perspective, execution from the short-term perspective should be the easiest part. Okay? These two perspectives do the anticipation. Long-term perspective does the anticipation. Okay? You're anticipating the market to trade high or low. Short-term perspective does the confirmation. Right? What does the confirmation look like on the short-term perspective? Well, if you see your entry pattern, okay? So the job of the short-term perspective is to find your entry pattern fractal within that color zone. That's it. You need to see it. You need to see the fair value gap. You need to see the MS shift, whatever your entry fractal pattern is. Mine is just the fair value gap. That's my entry pattern. If I see that within a kill zone, I'm taking that trade. That's all I need to see. But if you see that within the kill zone, especially with the context and framework from the long-term perspective and intermediate-term perspective, okay, that is confirmation, right? Seeing the pattern on your chart. You're not anticipating it to happen at a level. You're not already taking a short order at it, okay? You have to see the pattern and then take action on it. And you must know exactly your entry pattern. Do you prefer a stop run into a fair value gap? Stick with that. Do you prefer order blocks with a fair value gap? Stick with that. Don't be a jack of all trades. Have your own entry pattern. Mine is just fair value gap. I'm comfortable trading order blocks, but I don't trade breakers. I don't trade mitigation blocks because that's not my entry pattern. My entry pattern is just a fair value gap with an order block. Those two levels I'm using. And if I see that with all the work I've done in long-term perspective and intermediate-term perspective, and I see that pattern in the short-term perspective, okay, I see it on the charts confirmed, I'm taking that. All right? We do not gamble, we execute on solid setups. So know and study your entry pattern to the point where you understand and you trust its characteristics. So now let's talk about interbank routine and schedule. Every Sunday, you want to do the following. Step 1. Find the market narrative. Where does the market want to go? On the higher time frames. This starts with a proper analysis of the long-term perspective and finding higher time frame levels. Start with the dollar, then make your way into pairs of trade. We start with the dollar because dollar is the king currency that governs every market out there. So you don't start with the euro, you don't start with the pound, you don't start with the index futures, you start with the dollar. Because that will tell you to be bearish on foreign currencies, bullish on foreign currencies, or bearish on index futures or bullish on index futures. The dollar will tell you that because the dollar governs all markets. So, proper analysis on the long-term perspective for the dollar. Find your higher time frame levels for the dollar. Find a draw on liquidity for price and wait for these higher time frame levels to be active before formulating any trade plan on the lower time frames. Step 2. Create a framework. Okay? This is what you're doing on the intermediate term perspective. Study the economic calendar. Mark out the main news drivers for the dollar. Is the main news driver for the dollar early in the week? Is it on a Monday? Is it on a Tuesday? Is it on a Wednesday? Or is it all the way waiting on a Friday, like NFP? Right? If news is late in the week, anticipate midweek consolidation, an expansion Wednesday, New York session, Thursday and Friday. So midweek consolidation is consolidating and it's waiting for that news late in the week to then do its job in business to trade lower. But if the news is early in the week, anticipate for weekly highs and lows to fall Monday, Tuesday, and Wednesday. Monday might range, Tuesday forms a high of the week, then a lower. Or maybe there's excitement on the opening, you'll see Monday form a further swing up, and then trade lower on Monday, New York session, Tuesday, and Wednesday. Okay? But in this case, we're studying the economic calendar. We're trying to picture and manifest what that weekly range is most likely going to do. Okay, is that weekly high going to form early in the week or late in the week, based on the economic calendar? Okay, so this is the first clue for us. It's always going to be the first clue for us. Next, with the framework, right? So the economic calendar is going to give you an idea of when weekly highs and lows are going to form within that weekly range. Now it's time to find where is it going to do that. So identify levels that align with institutional order flow from the intermediate term perspective. Mark out market structure breaks, if any. Mark out intermediate term swing points, if any. Mark out where prices will in a premium or discount. Mark out potential intermediate term swing points, if any. Okay, so step one was higher time frame level. Okay, and then we're waiting for, based on the economic calendar, when can the weekly highs and lows form? And then we want to look in price action to tell us, where can it form? So on the intermediate term perspective, mark out if there's any market structure breaks, okay? Or maybe there's already an intermediate term swing point, mark that out, okay? Or maybe price has to trade back into a premium or discount, mark out that range, okay? Or mark out any potential intermediate swing points already, okay? Do we have a fair value gap here that price can potentially form an intermediate term swing point? Or did we already take out a high and we're going to expect a classical intermediate term high, right? Mark out all of these potential scenarios, okay? Because that's where, where we're going to find weekly highs and lows to form it. Then we want to blend that with the news events. So that's time and price. So ask yourself the following. Monday through Friday, what news events can cause volatility to activate these levels? Okay, so let's take scenario 4. All right, mark out potential area where price could form an intermediate swing point. So let's say price already hit a long-term level, broke market structure, and then there's a fair value gap here that has been untested. Okay, it's fresh. Let's say we have news here on Tuesday. Okay, ask yourself following. Monday through Friday, what news events can cause volatilities to activate these levels? So if there's news on Tuesday, okay, will that form an intermediate term high to bring price lower? Right? Or will price already test this, and then on Tuesday, the volatility is provided to bring it lower when the news happens? Okay? You're blending the news events with price levels. And that's how you create framework. Scheduling when to be active. So after building narrative and framework, you should see clearly where the price will want to trade towards next. It's either waiting to test a higher time frame level, okay, which is untested, or retracing within a daily range on the intermediate term perspective. Okay? So it's either waiting to hit a higher time frame level, or it's already hit the higher time frame level and now it's retracing within that parent price range. Or it's waiting to hit that higher time frame level. Okay? So price is here is waiting to hit that. You now have a plan for where price and when price will print important highs and lows. Is price going to print an important high here? Is price going to print an important high here because of a fair value gap? Okay. You know where and when these are going to happen. Kill zones, news events, price levels. It's your job to be active from the short-term perspective to participate on these entries. So schedule those days and specific hours and only be trading then. So you know based on the economic calendar when it should be active. You're looking, okay, what kill zone is that news event in? And then on that day, only then are you active. You're not going to be in front of the charts when price hasn't even tested this point here yet, because you're just going to waste your time. Wait for prices to hit this, then wait for a kill zone and a news event to look for action. Okay, and that's how I schedule my week. I look at the economic calendar. I say, okay, do we have news late in the week or early in the week? And if it's late in the week, I just take Mondays and Tuesdays and Wednesdays off, and that's how I can find the time to make these types of videos. If there's news early in the week, then I trade Mondays, Tuesdays, and Wednesdays, and then I take Thursdays and Fridays off because price has already moved early in the week. So I schedule my trading hours based on the economic calendar and what's seen in price action. So here's the action step. Create your interbank trading routine and schedule and use it every Sunday. So create your own routine every Sunday. Go through all these 3 steps I just mentioned. Start with the dollar index and make your way into the pairs you trade. And then create a schedule around the economic calendar. When do you want to see price hit these levels? Kill zones. But specifically, which kill zones? Kill zones that include news events. Because those are when markets are going to form important highs and lows. Alright? Then on Sunday, once you build your schedule, Monday through Friday, you'll know exactly when price is going to move, and you're not going to waste any precious time on the markets just staring at the screen and price doing nothing. Ultimately, you can use that valuable time to do something else. Go backtest, or go study, or go spend time with your family. This is how you save time and be in front of the charts when it's actually important. But not only will this improve your trading significantly, it will also prevent you from trading low probability trades. Because high probability trading is when the markets are actually supposed to move. And if the markets are not going to move because banks are not pushing price anywhere, then you're just going to frustrate yourself, which could lead to a downward spiral and more bad trades and more emotional trading. So if you skip this step, just know that you might face emotional trading for the week ahead.